Mortgage rates ticked higher this week, but not due to anything in the housing market. The two big factors are the tension in the Middle East and jobs reports. Welcome to Dre's Take. The average 30-year mortgage rate has climbed back up to about 6%, snapping that downward trend that we had seen for the past few weeks, and that's causing some affordability issues. It's not a huge jump, but in a market where affordability is so tough and very rate sensitive, it's definitely an issue. So what are the main factors causing rates to accelerate again? Well, it's these two main issues. Back home, it's the jobs report coming in weak, losing 92,000 jobs when economists had expected 50,000 jobs to be added. Now, a lot of that is due to healthcare strike activity, so economists aren't necessarily hitting the panic button right away, but it's not what we want to see. And second is this tension or turmoil, the war, if we just want to be right out front and say it, over in Iran. And the primary issue with the war in Iran for economics back home and therefore the housing market is the pressure that it puts on oil prices. Oil went from about $80 to $120 in the past week or so. I'm sure you've all experienced that pain at the pump. I know here in Florida, gas is about $3.80 now, which is about $1 more than when this conflict started. Now, what that means for inflation is essentially everything you buy touches a boat, a plane, or a truck at some point. And those increased fuel costs for transportation eventually bleed into the pricing of the products. And voila, you have inflation, you have higher pricing as a result. Now, these two things have been the factors that the Federal Reserve has been trying to manage this whole time as we've been trying to navigate this soft landing from the crazy inflationary period we experienced from 2021 through 2025. On one hand, when inflation is running high, the Fed would typically raise rates to curb extra money flowing into the economy. But on the other hand, when hiring is slow or unemployment's ticking higher, their main method would be to cut rates to spur hiring. So you can see the conundrum they're in. They can't really cut rates because inflation would jump, and they can't really raise rates because unemployment would soar. This was already a tough situation they were in, and now it just got a whole lot worse. It's almost certain that at the next Fed meeting, they will hold rates steady, but going forward now is a lot murkier of a picture than we had considered before. We figured they might hold for a meeting or two and then decline, etc. Now it's looking like they may hold for an indefinite amount of time, and some Fed officials are even urging or pushing for rate increases. But it's a tough scenario. I wouldn't want their job right now. So here's Dre's take. In previous videos, I talked about how things were stabilized for a while at that 6%, 5.9% range, and it gave buyers the opportunity to shop around, really consider their options, etc. Well, that logic goes out the window with these new events. Now the future looks quite volatile, quite unknown. So if you must make a purchase, then my advice would be to make a decision and get your contract locked in so that you can lock your interest rate in before further volatility kicks off. Now, on the other side of that, for sellers, your issue is this. You've got some buyers that are going to say, wait, let me see what happens with this. Things are scary. They're going to pull out of the market. That's going to increase days on market and give sellers more headaches. So patience is going to be critical. Now, I'll be keeping an eye on all of this stuff, so if you've got questions or concerns, I'm always happy to help. Feel free to reach out. A lot of folks probably ask, Andre, how do you even keep up with this stuff? And the sad truth is, I don't have much of a life outside of real estate and the gym. The good part about that is when you call me, you know that you're working with somebody who's completely dedicated to serving you. Until next week, that's Dre's Take. All right, y'all. Take care.